Welcome to the Traders Clinic, your regular shot in the arm of trader insights, philosophy and knowledge, brought to you by two professional money managers, Ali Crooks and Charlie Burton.
In each show, we answer your burning trading questions and cover all things from the world of trading.
Indeed we do.
So we're keeping up this theme that we've been doing on the last couple of episodes, which is we're going to cover one big topic and discuss it in detail. So the one we're discussing today is the theme is around the 80-20 rule. And I think this was interesting. We were chatting earlier and you had a couple of did you know facts that are really, really interesting, but they all link around this 80-20 rule.
Yes, so we were having a coffee earlier on. I said, let's put a did you know segment into the show. So did you know, for example, that in election years in the US, as we've got a big election coming up this year, that 83% of the time in an election year, the S&P will close positive. And with an average return, by the way, of around about 13% historically. So 83% probability of the stock market, US stock market closing higher in an election year. So let's see what we can do with that.
Well, now we've put it out there, it will probably be...
Yeah, probably go down this year.
Yeah.
I think well, we can start with that. One thing with probabilities is they're not certainties, they're probabilities. They're things that have happened going all the way back. These stats are going back to 1950. So there's a fair few elections since the end of World War II, basically. And although that is the historical average, it's 83%, it's not 100%. And even if it was 100%, there's no reason why at some point in the future that record won't get broken. So it gives us an edge, not a guarantee. And I think that's the first thing to go with when we're looking at these sorts of things.
I think with what's interesting is I'll talk to traders and maybe they've done some back testing and they'll come to me and say this strategy over the last 5 years it's had X% return on 4 of them, or it's won 6 years out of 7. So you can see that their faces lit up because the probability is in their favour. But I always say interesting. So I'll look at that and say, well, if it's had 6 good years out of 7. Then I'm almost thinking that next year has a higher probability of it not being a good year because you've had that period, you've had such a good run out of the last 7 years that my brain goes, well, hang on a minute, it could actually be that we're in for a losing year next year. Whereas the new trader will get very, very excited because they're sitting there going, well, it's had 6 out of 7 years. We're almost guaranteed a winning year the next year. And I think it throws up the question of how traders view probability. And they'll see something like 80% and it's almost 80% equals a dead cert for the next year or the next trading period or the next month or whatever it is they're looking at. And I think sometimes traders will put too much or feel too certain about a set of results and see it and feel it like a guarantee rather than looking at it as an edge. And I think if they could come at it more from the point of view, yes, I've got it in my favour, but it's not a rubber stamp. It's not a guarantee that the next trading period is going to end up being the same.
Still need to have stop losses because you could have someone who will take that information and say, well, it's 83%. Oh, it's bound to happen, as you've just said. And they'll just buy the market. Now, we're filming this in middle of February. And so the stock market, the S&P is already up 4 or 5% on the year at this point. Well, it could be that it ends the year at 4% up or 1% up, still positive. And so it still hits that 83%. And yet you've bought it at this point. So you can't just... No. And of course it could end up negative. So you can't just buy with especially as a trader. If you're unleveraged, then it's different information. If you're unleveraged, and you're holding on to stocks for the long term, as an investor, that's a different story. There's an asset allocation thing coming on there. We're talking about traders, trading on CFDs, options, whatever, leveraged stocks possibly. So any form of leverage, which most traders are doing, then you've got to have risk management in place, stop losses, and all of that. So if you've got that probability, what do you do with that? You've got to have risk management, but also you can, a trader who knows what they're doing will say, okay, I've got an edge there. So the trend is already in play anyway, so they're going to buy pullbacks within the trend. So they're going to use potentially a pullback strategy for that. Maybe they don't. Maybe they say, well, actually, yeah, I've got that information. I've got that probability there, but I'm actually a breakout player. So I'll let it pull back. And then if it goes back out and up and then breaks out, then I'll do that. Whatever. They're now applying the probability with some form of strategy which has risk management involved. And
yeah, they're not relying on one piece of information that sounds like it's a guarantee. And the other thing is going directly back to that piece of information. As you said, we're filming this in Feb. December's a long way away. The market could do a hell of a lot. It could go down and come back up. And like you said, it may only mean that it's 1% up. So somebody could go in, recklessly hearing that, and the next thing you know, it's June and they're down 5%, they're down 6% on their position, and then they're panicking and thinking, I'm not going to hold this. But
No, exactly.
a year is a long time. So it's also important to look at the time scales at which these sound bites and quotes come out, because they can be useful, like you said, if you're playing them and using them within a strategy.
So what else do we want to discuss on the 80-20 theme here?
So I've got one for you. Did you know that 80% of stocks that make all-time highs end up higher within the 12-month period?
Right.
So they continue to go up.
Yeah.
So again, we're not making any recommendations here. We're not suggesting people go and buy stocks. But again, it's that element of, well, okay, if I see a stock make an all-time high, then could I use that information within the strategy that I'm already trading? Maybe to give me a little bit more confidence, maybe as an element within I always call it like an ingredient within the recipe, rather than that's my entire recipe is, well, stock's made an all-time high, I'm just going to buy it. Because again, it's not all stocks, 80% of stocks.
Yeah.
And I think it's, again, not relying on that, hearing the whole thing, not hearing half the sentence, 80% of stocks, so therefore I'm just going to do that. Because again, it's a year's a long time. So it's a very similar idea to what you were saying. It's making sure that you're using that within the realms of your entire process, not just going, right, I'm doing that because it sounds good and it sounds like it's always good. Everything's going to land in my lap as a result of it.
And I think that we're talking specifically about the stock market today, which we don't often do. But over this last 12 months or more, since the stock markets, the US markets bottomed in October of 22, so over this last sort of nearly 18 months, I guess now, there's been a lot of pessimism. There's been a lot of retail traders who have just been shorting the rally time after time as the stock markets have been going up. So I always find that fascinating anyway. So what do you want to do? Why are you looking for the stock market to crash? That's that thing. And I keep on getting questions about that. Charlie, do you think this is going to happen and that's going to happen and stock market's going to crash? And well, yeah, I mean, of course, it always could do. But let's go with the historical probabilities that stock markets are predisposed to going up. They're engineered that way. That's why the stock indices, they remove the underperforming stocks periodically and they put new stocks in which have been growth companies or whatever, which are likely to do well. So you're better off going with the overall probabilities rather than trying to catch those occasions when there's going to be this massive crash.
Exactly.
And people have come very unstuck trying to do that.
Well, the whole psychology around that, I can remember it was only a few months ago when we were approaching the all-time highs, and there were potential shorting opportunities. And then the market didn't set up, pushed past the all-time highs, and then I had people saying to me, well, what do we do now? Well, just because we're no longer at those all-time highs doesn't mean that price can't. It was almost as if their psychology was, well, that hasn't happened, the crash hasn't happened, price hasn't reversed. Well, what do we do now? Well, we go with the price action that we see. It doesn't mean just because we've nipped above those highs, price can't go higher and higher and higher.
Yeah.
And I think it's very interesting that psychology around markets crashing, and you see, markets reach highs, and you suddenly see, well, I certainly see more YouTube videos with people popping up saying the crash is going to happen, this is going to happen, and the market's going to roll over, and all of this. And like you said, the markets are predisposed to going up. That's how they're engineered. That doesn't mean, therefore, you should be buying with no strategy, just buying and thinking the market's going to go up. Yeah. But again, it's the difference between a trader and an investor. Yeah. If the market doesn't roll over at all-time highs, you have to look at that market in a different way. The market is telling you, giving you clues as to where it might go next.
Yeah. 80-20. So you've got something else as far as...
We have, yes. Yeah. So the 80-20 mindset principle, and I think this is something I know I talk a lot about, and I have a lot of questions around this, and it's something we talk about a lot. Just just between us, because we believe it's such an important element that traders have to understand.
Yeah. Okay, so what we find is people spend an inordinate amount of time trying to find their technical edge. And you gave me a great quote earlier on. Do you remember?
Yeah, so I say a lot that traders will spend 80% of the time looking at a technical solution to what is usually a mindset problem.
Wow, I love that.
You can have that for free.
Yeah. That's a wrap. That's the end of the show. Okay, so yeah, they spend an inordinate amount of time looking at the technicals, and then only a very small, a relative amount of time looking at their own mindset. And yet we know that it doesn't matter what your technical approach is or how good it is, the strategy, whatever you want to call it, your method that you've devised, your approach to the market, if you haven't got the mindset, you're still not going to be profitable with it anyway. And yet people spend all of this time perfecting the back testing and the tweaking and all of that stuff as on the technical side of things, and not enough time on the mindset. I get it all of the time. I've seen traders with way over 10 years, 20 years experience who still succumb to the mindset side of things because they've never worked on that. They understand it. They understand,
yes.
Oh yeah, it's this, and you've got to, I don't know, be careful of fear, be careful of greed, those sorts of things. But they've never really spent the time on it. So once they're in a trade, let's go for an example. So you can jump into a trade. You get into a trade, and the trade starts going against you, and then all these emotions come up, and then you're thinking, oh, maybe I will cut the position. It's that type of thing that goes on. Now that to me raises a flag that individual hasn't spent the time pre-taking the trade mentally on taking the trade, that they are truly comfortable with the trade. Because every trade you take, you should be comfortable with it being a stop out. So if you get into a trade and you're finding that you're jumping out, well, you're just, and then maybe it then carries on going up afterwards or whatever. Well, it just says that you weren't mentally there for the trade, because people will say, oh God, my strategy, it did go up and I jumped out, and now you're frustrated and angry, and you're going to carry that emotional baggage onto your next trade and the next one and the next one. And maybe your approach is fine. So what you need to be doing is spending an inordinate amount of time on your mindset, not so much now on your technicals. Spend the time, invest the time. Okay, where am I pre-trade? How am I during the trade now? And keep the self-talk going. The self-talk is, right, I've got to follow my plan. I know I'm feeling like I want to jump out right now because I'm in this trade and it's starting to roll over. That's my gut feel. I've got to ignore that. I've got to stay with the plan. All of this self-talk during the trade as well is what helps you to stay with it.
I really like I call it the pre, during and post analysis.
Right.
And the amount of traders think that involves reviewing whether or not technically the trade was right. And then the post trade is making sure I've got the data in my spreadsheet. Yes, that's fine. You can have a pre, during and post trade analysis from a technical point of view, but how many traders are actually evaluating where their mindset and their self-talk is pre, during and post? Because what you end up doing post trade will often influence what happens pre-trade. And I know that when I first started out, there was a lot of reaction or little things happening during the trade, like maybe just getting out that little bit too soon, or just to get that feeling of relief. And you carry that through to the next trade. You'll then maybe try and, if you get out too soon on a trade, so you were meant to go for 2 for 1, and you get out at 1 for 1. Well, the risk is on the next trade, you then do something you shouldn't pre-trade, like you take a trade you shouldn't because you know you're a little bit behind on your reward, or you like you said, trade's going against you, so you get out too soon. Trade ends up winning. You bring that anger, frustration through to you on your next trade. And I think if more traders sat and actually evaluated where they were emotionally pre, during, and post, they'd be in a better position. And I could have a highlight reel of traders that I've spoken to that once they start really delving into the trading and are actually in the markets, in the depths of whatever strategy they're trading, the amount of times a trader has said to me, I completely underestimated. I knew mindset was important, ... but I didn't estimate how important it was, or I underestimated how important my mindset was. And I think it's, if you could impart that on traders before they started, but that's the thing, isn't it? You only really build your mindset when you're doing it. You can't, you could have a football player that on the training ground could kick the free kick 100 times and 90 times knock it round the wall and score, but will they be able to do that when it's
in a pressure cauldron?
In the actual match when there's 100,000 fans and there's only 10 seconds left on the clock and they've got to do it. Yeah. And the two things are different. I'm very adamant that trading, yes, you have to have a series of skills, but it's much more performance-based activity, not just a set of knowledge or a set of skills that you've brought up or technical skills. Can you actually deliver on that? And can you do what I call the 5 trade down? Can you be 5 trades in a hole and still stick to your plan on the 6th trade? Because invariably it's the 6th and 7th trade. Yeah. It makes you a trader. It's not the 3 or 4 winners in a row that makes you a trader. It's the 5th or 6th trade when you've had 4 losers on the trot.
And I think the other thing with mindset is it's not something that you just have a revelation like these examples of these traders who are like, right, I get it now. Yes, you get it, but it's something that has to stay with you throughout your trading. You have to constantly work on it. So, for example, I always use the analogy of trading mindset is like having a pot of water on a stove. You've got to give it constant heat. If you remove the heat, then it goes cold again. So you've got to keep doing those exercises of where am I mentally pre-taking the trade? Am I okay for taking this trade? Because you've got to be, otherwise last thing you want to do is take a trade and then jump out. And then again, during the trade, constantly doing the self-talk and all of that stuff, so that becomes the habit on every trade into the future. Because if you just think, oh, I understand it now, yeah, I won't do that. Well, that's all very well saying you won't do that. And then because the pain of the trade that you've just had or of jumping out or whatever it might be you've done is there and it's raw today. But in 2 months' time or even in a month's time, that's going to fade and then you'll go and repeat the same thing over and over again. So you'll swear, I'm never doing that again. Then funny enough, a month down the line, you're like, oh God, I've just done it again. Well, I'll never do that again. Yeah. And then it carries on because they're not working on it. In the moment, they're like fully acknowledging what they've done. And then gradually with a bit of time, the little devil comes out on the shoulder again and he's saying, go on, take it, bank it. You know it's going to roll over. Or if you come out now, you'll save yourself those extra few points because it's going to come down and stop you out. All of those little things that traders do, they're going to re-emerge unless you are constantly staying on top of that. So it's a constant thing. It's like training. You know, you don't train and build some muscle and then think, well, I've got muscles now. I'm not going to train anymore. You've got to keep it going.
I think you're in a situation as well, in those moments, very often that learning comes post losing trade run. I didn't realize how much time and I've really dialed in on my mindset. I understand its importance. I'm doing the self-talk and then the nice winning run comes and the discipline drops off. Yes, they might be executing their trades correctly, technically, but they're not doing the work on the mindset because they're not going through a bad period. And something you've said in the past, and I say this to other traders as well, is when you're going through that bad period, bottle it, remember it. Yeah. Don't sweep it under the carpet, remember it, because it's that inevitable scenario will occur 6 months from now, a year from now. And if you're bottling it and remembering it and working on it even through the good times, then there's the potential that when that next losing period comes, you're in a better place. Yeah. Because you're not in what I call recency bias mode, is basically reacting to whatever's going on in your trading. I need to work on my mindset because I'm having a bad period. Now I'm having a good period, everything's fine. It's much easier to stick to your rules and everything will be good if you're ticking along nicely. I always say to traders, sometimes win loss is actually quite a nice period because you've got winners and you've got losers, but if you've got your risk to reward right, those winners are outstripping your losers. It's when you have that 4 losing trades in a row, 5 losing trades in a row. Have you actually learnt from the last time that happened?
Exactly, because it's going to happen again. Yeah. Actually, it's likely you're going to have 10 in a row. Most traders will have 10 in a row or more at some point. You take enough trades, statistically, probability-wise, it's going to happen. So why not prepare for that now, rather than thinking, oh, that's never going to happen to me. One thing to note on this, coming back to this whole 80-20 thing, and we have the data. Our brokers have the data. They have to publish the information here. They have to publish the percentages of traders that lose money. And all right, I'm finessing it a little bit because a lot of brokers might be in the 70%. So I'm going off the top of my head here. I don't look at that information all the time. But let's just go with 80%. Let's just say it's 80. It's probably a little bit less. But again, if 80% of your broker's clients, all right, maybe it's 70%. If it's 70% of your broker's clients are losing money, you should know the reasons why they are losing money. Well, it might be they're not using stop losses. Well, that's either fear of taking a loss, or it's ego. The ego doesn't want to accept having a loser. They've got to win at all costs, sort of thing. But the point is that they are chasing being right more often. So do you want to be like the masses out there, who we know the masses are losing money, or do we want to be like the smaller percentage, that 20 to 30%, who are actually making money and they aren't trading like the others? If you keep that in your mind, then it might just help you when you're thinking, I've got to be right 80% of the time or whatever for your trading, and maybe have a completely different view on how you should approach trading.
I think so. And on that note, we'll call it a day. He's Charlie Burton.
And he's Ali Crooks.
Trade safely out there.